So let's look at this kind of progression of folks, right? People will go through and they'll start measuring their income. When you start measuring your income, the natural next step is they'll kind of compare your retirement balances. Hey, am I on track to retire? We'll look at certain things like, oh, how much equity is my personal home? And then we'll start calculating things like your net worth. But what stood out to me is that someone could look really, really good on paper, right? Where your income goes up, your house is appreciating, that 401k, I'm a 401k millionaire, right? My business is being more valuable. That net worth will end up crossing seven figures, but they may still need that paycheck, right? That's that paycheck that's going to fund the very next month of their life. And that doesn't mean that things are bad, all right? What it means is that those numbers aren't answering the entire question of what does that family actually need? What that income earns you? Welcome to another episode of WealthWise Banking. I'm Jeremy Huggins here with my co-host, Jason Sipple. How's it going, man?
Fantastic, man. Always happy to be here with you. Excited to kick this off and have some fun together.
Yeah. So today's episode was kind of a continuation of what we discussed last week. And when we were sent that video, we had a couple follow-up questions. Like, if you guys do have questions, if you have comments or some things that you want to know, send them to us. Let us know. Let us know what you want to talk about. Right. At the end of the day, this is all built for you. What we kind of looked at from going from the last week's episode to this one is that we have members who do make great money, right? They have assets, they have 401ks. And a lot of those things, with time, the value in their net worth keeps going up. And for a lot of folks, especially people with 401ks, they find themselves being a 401k millionaire pretty early, especially if you get that employee match, right? But if you're 42 years old and an opportunity shows up today, or let's say that something happens in your business, you need capital, or heaven forbid, your parent or kid needs help in a medical bill. What does that $1 million in your 401k do? Like, is it actually available? Or are you paying taxes, penalties, selling something? So that's the question we're going to get into today. And we're going to walk through this and see how financially free are you really? So Jason,
Yeah,
what are
yeah,
your thoughts?
no, that's the contradiction, isn't it? You just talked about someone being a millionaire, and then someone told or someone can do almost everything they're told, right? They look wealthy on paper, and they still can be completely dependent on the paycheck, on the next paycheck, right? So they're
Yeah.
just, yeah, go ahead.
Yeah, like last week, we talked kind of exactly about that, right? We're looking at the difference between ongoing and having good investments versus building a good financial system. And I think that's what you really need to understand here is we're building systems. We're not just building assets. We're actually seeing how do all these things come together. When we're really starting to look at like kind of the numbers, we're looking at savings rates, we're looking at people's net worth and retirement balances. We kind of want to go back to that uncomfortable conclusion that we keep finding time and again is that numbers for most people are just a measure of progress.
Hmm.
They don't always measure your financial freedom, do they?
No, and they definitely don't measure. I mean, the studies we were looking at from the Fed, from the Census Bureau, from one other trusted source is, a lot of people seem like they're winning. And then when we started looking at it and started breaking down their numbers, and we started realizing, wait, these people are well above right average, and they're ahead of the curve, but they don't feel like it, right?
Yeah. Yeah, no, it doesn't. So today we really want to start looking at three questions, and these are things you can implement in your life.
I love
What do
these
you
three
keep?
questions.
Yes. So question one, like, what do you keep? What do you access? And what cash flow does it create? Because you could have a very large net worth. You could look very, very wealthy, but that access, that liquidity, how does that actually feel when life throws you a curveball? So again, the three questions that we're going to go through is what do you keep? What can you access? And what cash flow does it create? So let's get into it, Jason. You ready?
Yeah, I'm ready, man. I'm ready. I'm born ready, man. What are you talking about?
All right, so let's look at this kind of progression of folks, right? People will go through and they'll start measuring their income. When you start measuring your income, the natural next step is they'll kind of compare your retirement balances. Hey, am I on track to retire? We'll look at certain things like, oh, how much equity is my personal home? And then we'll start calculating things like your net worth. But what stood out to me is that someone could look really, really good on paper, right? Where your income goes up, your house is appreciating, that 401k, I'm a 401k millionaire, right? My business is being more valuable. That net worth will end up crossing seven figures, but they may still need that paycheck, right? That's that paycheck that's going to fund the very next month of their life. And that doesn't mean that things are bad. All right. What it means is that those numbers aren't answering the entire question of what does that family actually need? What that income earns you versus what the net worth has accumulated. Neither one of those things by themselves tells you how financially free you actually are. And I think that's kind of the contradiction here, right? I look great on paper, but I feel freaking broke.
And I think that's a pretty universal feeling for a lot of our builders, a lot of high income individuals. I often think of it like this, Jeremy. It's like if you don't really understand the system and you just keep measuring the numbers that everybody tells you to measure, then you're building a bigger prison.
Mm.
Right? You're just building a bigger, more expensive prison that, potentially can come crashing down even harder. So like if you're listening to this, just as your income and your net worth increased, did your dependence on your paycheck decrease? Just answer that simply. If the answer is yes, awesome. If the answer is no, then, we need to talk. You need to keep listening.
Mhm. Yeah, so when we're looking at that and determining whether or not we're dependent on a paycheck, that gets that back to that first question, right? What do I keep? That's the first simple question that we want to ask is what do I actually keep?
Yeah.
And when I think that most people listening to this, they start having a hard time answering that accurately. Why is that, Jason? Like, why would they have a hard time answering the question, what do I keep?
Well, I mean, there's a lot of reasons here. I personally think it's because the system's designed to move people away from their money. Everything's easier to buy. You swipe your phone, you swipe your credit card, you swipe this. And then people confuse their retirement contributions with what's going to their future self with their total savings. And they may count money that is later withdrawn, or that they might count other buckets of money. They might overlook annual bonuses. They might have irregular income coming in or business distributions, and they're not separating everything out. They're not close enough to their money. They have all these different segmented accounts and things, and they don't really know what is the amount they're keeping.
Yeah, the savings rate, right? The savings rate was kind of that big thing from the last episode that we talked about, where someone say, "Hey, you know
That's the
what?
big lever, man. The big
Yeah,
lever.
it's a massive lever. I'll save 15% because I'm contributing 10% to my 401k,
Yeah.
and then I get a 5% company match, right? So I'm getting 15%. But that savings account, well, for a lot of folks, if you are saving something, where does the money go? Like, what are you actually keeping? Is it going towards vacations or cars? Heaven forbid, fucking taxes, right? Or is it going out to emergencies? Credit card
Well, you had a
balance.
little energy around taxes. How you dropped an F bomb in there too. So
Yeah,
anybody
you
here
know how
not
I
pay
feel
enough in
about that.
taxes? To our listeners, do you guys not pay enough in taxes? So anyhow,
Yeah. No, but typically, there's an entire principle behind this. As our income rises, so do our expenses. And what passes through our savings account, our investment account, we kind of look at that as part of our savings rate. But how much of this year's income actually benefited your family permanently? Like how much of your money did you actually keep? And
yep.
that's the number that a lot of our builders will end up tracking.
And I love that, because with that, it's pretty easy. You've heard me talk about this, Jeremy, before, and we might have even talked about in one of our podcasts. But there's this concept, and a lot of people just kind of miss this. Like, you have the accumulation theory, but you have a concept of, like, right now there's how many of us on this podcast, and some people would say, hey, there's two of us. No, but there's four. There's Jason present, Jeremy present, Jason future, Jeremy future. And when we're saying, hey, we're saving 15%, but we're saving it to our future self. Well, then what happens today? What
Mhm.
happens today when the money's needed? What happens today when we don't have access, right? And that's why it gets confusing, because you do need to think about the future. That's long range thinking, but that future self isn't today. And so, like, give the folks, you kind of came up with a simple savings rate formula that we could share today. And I'd write this down if you're listening. If you're not driving, definitely take a moment and write this down.
Yeah, so you'll take your money retained during the year. Like how
Go
much
slow,
money did
Jeremy.
you
You
actually
tend to
keep?
go fast. Go slow. So your money retained over a year.
All right.
Okay.
We're going to now divide that by your total after-tax income.
Okay.
Now that money retained, that can include things like your cash reserves. It can include your retirement contributions and the things going to your brokerage accounts, all right?
So if you
But I
made
want
a if you
you,
made 100K and you have 10,000 left, then your savings percent is 10.
you
Yeah?
could look at it like that, right? We're
Okay.
looking at where you're saving it because to your point, we have different buckets,
Yes.
but you still have to go and subtract out the savings that was withdrawn. Either it was consumer debt, maybe somebody went out for lifestyle expenses. Okay. So it's not just, hey, I put money in this account, like a high yield savings account, but money later came out of that account to fund this next expense. What we want to look at is the money retained during a
Well, that's what I
year.
mean. That's what I was saying. If you
Yeah.
have 10,000 left over, I mean, that's the simplest way to do it. Is whatever's left, actually left, not spent, doesn't get drawn out for an emergency or an urgency or something like that, right? What did you actually keep? Again, back
Yeah.
to your first question.
Yeah, because we'll have folks that'll make $300,000 a year and then they go out and they spend $300,000 a year versus someone, if you want to look at who's getting better towards financial independence, maybe that person who's making 50K a year, but they're saving 5,000 a year. Well, if you look at it on paper, they're actually further financially ahead because that future 5K invested over time, put it into, different accounts could actually get them a higher net worth than the person who's making 300 and spending 300.
Yeah.
So who's actually ahead financially? Because income will create the opportunity, but retention creates the capital. That's the thing that you need to take away here.
And I love that. And I just had a client call the other day, Jeremy, where this gentleman was this business owner, electrician, was the second best saver I've ever talked to. I once talked to a retired military guy making 80, saving 50%. This guy made 300, saved 50%.
Wow.
That is impressive, right? How many conversations have you had like that? Out of thousands and thousands, I've only talked to two.
Yeah, not everyone has a great savings rate. Money in, money out.
Yeah, but just think, if you're making 80,000 saving 40, you're doing better than someone making 300,000 and saving none.
Mhm.
Like that's the
Yeah.
math we're talking about today.
And when you get into that system, right, what ends up happening? Well, the paycheck typically becomes your financial system.
Yes.
It's going to become what's reliant because your mortgage
Yeah,
will get
you're the
paid.
engine. You're the
Yeah,
engine.
yeah, retirements are there, where kids' activities are getting paid, vacations and everything else, but you're still reliant on that paycheck. And that all tends to work until what happens, Jason? Until what the income stops, right?
And this question for our listeners might be a little uncomfortable, I think, Jeremy, but just reflect on this and actually answer it. Like, go get your notebook, go get all your financials, your QuickBooks, whatever. But what percentage of last year's after tax income still belongs to your family today?
Hmm. Yeah, and that's what gets measured is what matters.
Yeah. I
And if
love when you
you're
say that. I don't know why that makes me happy, but I actually really I love when you say that. That makes me happy. I wonder if it makes the listeners happy. I know it makes your mom happy, right? She's listening. So
yeah, she's listening. Hey, mom. Yeah.
and
So I think part of that whole strategy there is the high income illusion of this is your paycheck for a lot of folks is the financial system in and of itself. And when the income stops, well, and the music stops, right? You're kind of just left holding the bag, right? If you have a career change or heaven forbid, again, a health problem or a major opportunity, let's go the other way. Opportunity shows up and the capital is being needed this week. Where do you go first for capital, right? Your family might rely on that. A high income can still allow for a very weak structure because you didn't build something to last. It wasn't built for a very long time. And when you're looking at the issue here, the true issue is that you're not necessarily overspending. What it is that your family's financial freedom is truly tied up and funded by your active labor. Think about that for a moment.
ooh,
Your
yeah, say that
paycheck
say that
is the
again.
system.
Say that again, right? So again, the
Your,
issue is not overspending. It is the family's freedom is still being funded almost entirely by active labor. And this reminds me immediately, Jeremy, of one of Warren Buffett's quotes I always think about. It's like, hey, you either learn to have your money make you money while you sleep, or you will trade your time for money for the rest of your life, as long as you're alive.
Mhm.
It-
No, it's
It's
good, right? Like if you're
it's what we're
looking at
saying.
it and thinking about this, like is your income actually building you freedom or are you simply maintaining your obligations? Think of it like that way. Am I actually, is my paycheck my financial system? Or Am I building access, liquidity, long-term growth? Am I building protection? Does my dollar have multiple jobs? So that's kind of getting into that first, insight there. Your net worth, it will look at your assets minus liabilities. That's how you measure it, right? If you want to look for a formula, net worth equals assets minus liabilities. But when you get your net worth, it doesn't necessarily reveal how much money can actually be used today. It doesn't reveal how much money you can actually access. Like your net worth is not a reflection of what's actually available. Again, you could be a 401k millionaire. If you're 42, you're SOL if life
Hmm.
shows up.
Yeah, I mean, and we talked about this prior to the show, but you have, you're a big fan, I think, of Kevin O'Leary's, right? Mr. Wonderful from Shark Tank. And he makes a really blunt point here, right? So he talks to people who consider themselves wealthy and asks how much liquidity they actually have.
Yeah, yeah, he does. And you'll be amazed at how many wealthy people say that they're rich, but they have zero liquidity. Like that's kind of his whole point of it. It's like, hey, I'm really rich. All right, cool. Hey, you want to do A, B, C, and D? Oh, I can't. Why not? Well, I can't afford it. Well, I thought you were rich.
Yeah. Yeah, look at the house you live in, the car you drive, right? You got a lot of money. Look at what you're dressed in. But
Mhm.
you can't do that? Why not? Right? So,
Yeah, you can own a lot of things of value, right? When I look at things of value, like a lot of people's values in their house. A lot of people's value might be in some sort of asset like a retirement account. But what good is that value if you can't use it, right? If you can't use it today, what do you actually have? Like you could have a valuable home, you could have a business that's growing, a large retirement balance, private investments. But if you have no access or liquidity to it, like what do you actually have? Like you have assets, but no access at the end of the day. So again, that net worth, it could be very real. I'm not saying that it's not, but you still might be trapped. It could be trapped because you have to sell something to gain access to it. It could be trapped because you may have to incur taxes to get access or a loan against it to get access, right? Those different restrictions and ages and IRS regulations doesn't necessarily mean that your net worth is a reflection of what your access and liquidity is, right? Net worth is the valuation. Liquidity is your capability. And cash flow comes from this. Cash flow is the experience. So net worth is the valuation. Your liquidity is your capability, but cash flow is the actual experience here.
yeah. I like this line to make it so you remember it. It's net worth tells you what something may be worth, but your liquidity tells you what you can do. And I don't know, Jeremy, about you, but me, I'd like to have more experiences and more freedom and more time that I can do what I want and have the cash flow to do it.
Yeah. Yeah. I mean, I see it all the time in talking with a lot of folks, a lot of members, and they love celebrating that 401k, don't they? Like,
Yes.
hey, like I got a ton of money. I get the company match. I'm putting this money all in here. And then it's like, all right, tell me a little bit about how do you respond to an urgency today? Like define an urgency. Okay, well, an urgency is the AC in my car went out, or hey, I mean, I just got a phone call 3 days ago about the washing machine in a rental unit going out, right?
Yeah.
That's an urgency. An emergency situation. Oh shit, we can't make payroll by the end of the week, or my parent is going to the hospital. I need to help them out. Like that's an emergency situation.
Yeah. And I'll tell you,
Opportunity. Opportunity shows up, right? Urgencies, emergencies, and opportunities. How good
yeah.
is your 401k when you don't have access to it?
Think about this, like just do the math for a second. This was in the episode that kind of prompted this, but I was listening to him like, oh, that makes a lot of sense. Like the actual return in someone's 401k is probably 7%, right? Over time. And then when they have an emergency, they have a family member go to the hospital, what happens? Well, where do you need to get capital quickly? If you're someone's high net worth, you probably have access to a lot of credit. So you go out and get a credit card, and then you end up not paying it off promptly, and you end up with 21% that you owe, and you're making 7 on what you're saving. Like you're minus 14. You're really backwards. You're kind of fucked, right? When you start looking at math in those terms and you start saying, okay, well then again, it is the liquidity that's the most valuable for when we have urgencies, emergencies, and opportunities.
Yeah. I will say this though, that if you have a 401k and or any sort of savings discipline at all, that is something to celebrate because you have good money patterns. So let's start there. Like
Yes.
you did take the discipline to pay yourself first. And I think that is worth saying that, hey, I can do this consistently over time. And if you're able to take advantages, right, that might be a good start. It's a good start, though. It's not the finish line, to be very clear. You could have $1 million account, but you may still need to use a bank. You could have a giant 401k or retirement account, but how do you actually solve like future retirement problems while having access to liquidity today? Like it's not there is a both and solution out there, and we'll kind of get into that both and. I'm not saying that you have to have either or. Most people think it's an either or. What Jason and I are talking about is a both and strategy. So the mistake here is not owning the retirement account. I'm not saying don't own retirement accounts. The mistake is asking the retirement account to be the entire financial system. So you're either looking at it where my paycheck is a financial system or my retirement account is a financial system. Can you have your cake and eat it too? Can you actually do something where the 401k millionaire, the future millionaire, can they be cash poor today? The answer is yes. We've seen it time and time again. $1 million that you cannot use to solve today's problems doesn't make you any better off than the person who doesn't have a 401k. Retirement and wealth, they can be usable, but wealth is not the same thing as having access and liquidity. Okay.
Yeah, I mean, and that's again, like you're saying, because the numbers, right? If you got $1 million and you need a 401k loan, most likely you can only borrow up to 50,000, right? Like how, right? Just numbers for people thinking. So the mistake's not, again, like you said, celebrate. If you're saving, you're already doing more than most. You're already a builder. You already have the discipline, and discipline's doing what is right. And you're following the first law of wealth. So the mistake's not owning the retirement account. The mistake's asking, like you said, the retirement account to do everything, to be your whole system, to solve all the problems. And like you said, a future millionaire can still be cash poor today, right?
Yeah. So that brings us now into question number two. So we did a lot there in question number one. Okay.
We sure did. I told you this to be a long one, folks. But
Yeah. Question two is what can you actually access? And that's kind of the transition here. All right. We've kind of hinted around it. When we say access, Jason, what exactly should the listener be examining when we say, hey, what can you access? Like there are certain things that you should be looking at to see what is usable.
Well, yeah. I mean, you want to see, do I have to sell something? Do I have to sell an investment to use it? Does the market need to be open? Could the value of whatever it is be going down versus up when I need the money? Is it going to create, I mean, this is a big one, right? You kind of got a little upset earlier, but is it going to create a tax bill? Is there an age restriction? Like, am I going to be penalized for being too young? Do you need a credit approval? Do you need the bank's approval? Do you need to go and jump through all these hoops? Who's actually in control of the scenario? I mean, that's a big one, right? Who's in control of the scenario when you need money? So would using the money damage another goal? Accessibility is not simply whether the money exists somewhere. It's whether accessibility is whether the family can use it without creating a second problem.
Yeah, think about that for a moment. Can you access this without creating a second problem? Like Jason just said, all right, second problems could be the tax bill. It could be penalties, right? What do you have to sell that you didn't want to sell? Did you sell too early in order to access it? Just because you have it there, in real estate, prime example, a lot of the net worth for real estate investors is tied up in walls, illiquid assets. I am asset rich and cash poor at the end of the day. So for every major asset, what we need to be looking at is how quickly can I access this cash, right? What does it cost me to access this? Do I have to disturb anything? Or, hey, is there someone else that's even involved in the approval process? When we're looking at real estate as an example, I might have to get a bank involved if I'm looking for a home equity line of credit, or if I'm trying to sell the asset. That's an approval process, right? It's multiple parties. What I want to look at is a strong balance sheet, but I don't necessarily want to look at the largest number on that balance sheet. Maybe I want to look at the most options. And that's kind of what we're going to look at. Like assets matter, but those options that we have, those options are the control. And we as builders, we want control of our finances. We don't want to hand that control over to someone else. At the end of the day, your financial freedom is going to begin where when you need to start looking at whether or not you have to ask for a request, right? Do I have to get permission to access my money? Or are you actually financially free? Just because you have a bunch of money sitting around, hey, I'm financially free. Getting back to the point, okay, Let's go on vacation. Well, I can't. Hey, let's go do this together. Well, I can't. What do you mean you can't? I thought you were rich. No, I just don't have access to my money. I'm asset rich, I'm cash poor. I'm a 401k millionaire, but I can't touch it without taxes and penalties.
And that's going to cause a lot of stress because you're not living life so you can work more and have more things, right? You're trying to have experiences. So that's if that's making you uncomfortable, it feels uncomfortable. I think it's pretty normal. I think this is a pretty normal pattern that we see across a lot of folks that we speak with. And with that, I always think of like when you were talking, I was thinking, yeah, every action has an equal and opposite reaction, and everything has a trade off. Like everything we build for people that we help them with, it does have a trade off somewhere. And you just have to understand what are you trying to accomplish? Right.
Mhm. Yeah.
So,
And that we've talked before, what is this money designed to do? Like you should actually give a destination to every dollar. Like what is it trying to do? If the answer to that is I got to pay the bills, I got to get out of debt, we need to step back from that and look at your money patterns, right? Because if the answer to every single thing is I'm just trying to get ahead, well, I got it. You don't have a net worth. You're just trying to survive. We have to take a step back from that and see what are your money patterns. That's a different conversation. This conversation that we're having is for the people who say, I'm already doing the right things.
yeah.
I'm going to challenge you. Do you have access? Do you have liquidity? What can you actually access today? Because guess what? At retirement, no one can eat their net worth. All right. You can't pay the electric bill by showing the company your freaking balance sheet. Hey, look at this. I'm worth all this money. But you can't take it to the grocery store. You can't actually go get a loan, right? Your assets have to be productive. Um, they also likely have to be sold to access or borrowed against. Like that's the other option. You sell it or you borrow it, or it has to be converted into something else. That's why the same two people who make $2 million can live completely different lives. One may have access to control, the other one doesn't. One person can generate dependable monthly income. The other person needs to use a lot of that money, but it's locked up into what? Real estate. It's locked up into qualified accounts. It's locked up in the things that they just can't touch without penalties, fees, or taxes, right? It's the same net worth, but it's two completely different life scenarios, two different financial freedoms. One is numbers based, one is based on reality. What do you have access to?
And again, I like that you're going through as you said, hey, you retire, your income stops, but everything else hasn't, right? And so if you're someone that's cash poor, now what? Right? Now what when you want to do stuff because you're not even the engine anymore that's going out there. So your net worth's telling you again what you accumulated, but your cash flow is going to actually tell you what kind of life the accumulation can support. Like what kind of life. And really, your number, I mean, I was thinking about this earlier. Your number is just whatever all of your costs are plus a dollar.
Hmm.
That's your freedom number. It's just whatever your needs are, your expenses, your bills, everything plus a dollar. That's your
Hmm.
freedom number that you're looking for so you can stop working, right? That's what we're working towards here. We're kind of running you through these three questions, but it's really to start giving you a different framework to think about.
Yeah, and that kind of leads us into cash flow, doesn't it? Like that, the third question here is, what cash flow does my retirement create, or what does my living expenses create? Like, what can I actually get out of this? What is the income that I need? Your balance sheet, like your retirement, it's not the full picture here. And when we say cash flow, we're not necessarily talking about like your rental portfolio or dividends. Okay, what we're looking at, cash flow can come from like many different
A lot of
means.
different things.
Yeah, like it can come from your business. It could come from rental real estate. It could come from different investments and dividends. I know we mentioned Kevin O'Leary earlier. He's a big fan of royalties, right? Maybe cash flow comes from Social Security, or maybe it's a portion of your military disability check, right? There are productive assets out there. What we need to figure out is what can you actually access? What does that cash flow create? How dependable is it? Here's a big question. How dependable is it? Right? Are you being taxed on it? Does that cash flow rise or fall over time? One thing that I look at is it tied back to your labor, kind of going full circle here, right? Is it actively tied to the labor that you're doing? And here's another one. Can it survive the market? Is it
Mm.
market correlated or non-market correlated? Meaning, does this cash flow go up when the market improves and does it go down when the market declines, right? Bull and bear markets. We're trying to figure out, do you have to sell the asset? Like these are all questions that we talk about when we look at your structure to figure out what is the financial system that you actually have in place today.
And there's a lot of great things that you could, I mean, just, and you're probably going to have multiple streams of income depending on what you do. If it's your business, a lot of business owners, you start creating passive income by replacing yourself, right? That's how you buy back your time. You create legacy and you create people underneath you that can keep going and doing the things that you're adding value. And that's how I've seen like someone go from one student in martial arts to having 50 schools globally with a plan on getting to 500. And I
That was done on
know
a system though.
he's built a system that brings money in. I mean, this is
Yeah.
what we're talking about, what the wealthy do and how they
Yeah.
create. And he has dividend paying stocks. He has money. So it's not just one thing, is my point. If you're going to have freedom, it's most likely not just one thing because, like Jeremy said, if the market's down, you have your money in the market. Well, you don't want to be taking that money out when it's down to use
No.
it, right? So,
Yeah. So kind of to recap, right? Like the three questions we're talking about is like, what do I keep? What can I access? What cash flow does it create? All right. If we want to look kind of like at a financial freedom test, and we're asking like, hey, what can I access? We're saying, or what we're really looking at is the large numbers that you have may not necessarily create present day control. You may not be able to access it until the IRS tells you can. So what can you access today? When we're looking, or when we're looking at what it is that you have, like where's the wealth at? Like, does it leave your family immediately? Do you get to keep it? Can you access it? What does it create? Ideally, it's creating multiple revenue streams. You want to have a dollar that has more than one job, right? And it doesn't need to be complicated. It's really comes down to create, access, and produce. If you want to think about it, it's like this a little formula. I love formulas.
you
So
do, you
we,
do. You like, I
yeah.
like it too because it makes it super simple, right? We have an account for urgencies, emergencies, and opportunities, and we're really looking to keep, access, produce. Pretty
Mhm.
simple.
So how do we like to do it, right? If we're looking at creating more, keeping more, producing more, what is we looking at here, Jason?
Well, here's where we come, where we want that we talked it. It's an and both strategy, right? We want to use our family banking system because that's going to give us that layer of accessible, protected capital while we can have other assets are going out and producing or pursuing growth and cash flow.
Hmm. Yeah. And so how is a family doing it, right? They're intentionally redirecting part of that income into a long-term asset, one that allows every dollar to flow permanently into their family system, right? That's the access part. The way that we design that is typically through a high cash value life insurance policy, the one that predates the IRS tax code, right? What does that do? Well, through policy loans, we can actually take the money, continue the compounding. It does not affect your credit. So get very clear. You can take policy loans. Your credit's still intact, but you can use that dollar for urgencies, emergencies, opportunities. At the same time, it has a job because the wrapper is a policy
Hmm.
of providing protection for your family tax free, right? That death benefit helps your family be protected. That income is now absent of your labor, right? We divorced your labor and gave your family a protection piece, an umbrella over top of the entire system. The thing that I like is that there are no IRS regulations when it comes to accessing your cash value. You can grow it, compound it, access it tax free. It's a both and strategy. I'm not saying it's the entire strategy at all. It's a foundational piece of the system.
No, let's even keep it simpler. So the study we were looking at, Jeremy, again, went back to that 4.5%. That's what the average American, most Americans are saving now, and it's going down, right? It's going down because we're consuming so much. If you pull the lever and you make that 15%, that changes everything. Now, what we're talking about is where are we keeping that 15%, right? Like, where are we keeping it? And we're saying if you want cash flow, if you want control, if you want guarantees, then maybe all or the majority of it should be going into your specially engineered privatized banking system, your high cash value whole life policy, right? And then you can go out and put it to work. Then you have liquidity. Then you're not wrapping it up or putting it into the future where you can't access it until a certain period of time.
Yeah, I if I'm 42 years old and I've got 100 grand in there, I don't have to wait till I'm 59 and a half. I don't have to wait till retirement. I can pull it
How long
out.
do you have to wait?
Uh, We're talking about from the day of first funding or literally after it's been maturing?
No, I mean, you got it in there. You said it was in there and you're 42, so you kind of fast forwarded a couple of years, I believe. You're not quite you're not quite there yet. So,
No, so if I get a funded policy, I can go and get the money out of my policy within a week, right? So I put a request in on Monday. I'm probably going to get it by Wednesday, Thursday at the latest.
yeah. And
So that's going to
sometimes
be
it
able to
depends on how
respond.
much you're
Yeah.
trying to access to. But yeah, it's usually 3 to 5 days, right?
Yeah,
Typically.
so urgency pops up, emergency pops up, opportunity like real estate, business, different investments. I'm able to use that money in a hurry, is what I'm getting at.
Yep.
If I had it tied up into an IRA, well, I'm not going to touch it till I'm 60. Or if I am going to touch it, I got penalties, I got fees, right? I got someone telling me how to use my money. At the same time, I am also growing a large death benefit. That death benefit is meant protection for my family. It's also part of my wealth strategy, right? When I have the beneficiary of my death benefit become my trust does what? Tells that death benefit to go purchase new cash flowing assets. Those cash flowing assets do what? They pay the annual premiums and my policies. That does what? Builds cash value that's available for my future family, urgencies, emergencies, and opportunities that ends up building more death benefit. I'm putting my family's wealth engine on autopilot and giving them full access and control the entire time. We're not locking it away. There are no penalties or fees here. That's the beautiful thing about it. It's one asset funding another in perpetuity, tax free.
Yeah, in perpetuity, tax free, and every time your family gets bigger, guess what? You're adding another piece of the engine to it, right? You go and protect that person and start building the system all over again. So that's how it lives in perpetuity. That's what Jeremy means by that.
Yeah, it's a cash flow, liquidity, and protection system. That's what it is. Well, we're all talking about systems, right? This system gives you cash flow, it gives you liquidity, it gives you protection. That's $1 serving three jobs all at once. The value of this truly depends on the design. You hear a lot of misinformation out there. You don't have access, you don't have liquidity. You're right if it was designed poorly, right?
Yes. Yeah.
It also depends on certain things that you're doing, like your lifestyle choices. Like, are you starting late in life or did you get that started early? Do you have good, healthy benefits, right? There are things that we have to take in consideration. At the end of the day, I don't get to put the final approval. All I can do is design the strategy for you, and then you got to carry it over the finish line. To be very clear, this is your plan. It's not mine. The implementation of it is your plan. It's not mine. We're just here to give you access and liquidity and protection, but you're in charge of your own wealth. Nobody cares more about your money than you do. Not me,
No,
not
we're
Jason. You do. So when we're looking at foundational sources that give you cash flow, liquidity, protection, what other asset out there is better? This is the asset class that we like to use as a foundational level. That foundational level answers all three questions, right? What do I keep? All right, that's question number one. Question number two, what can I access? Question number three, what does it produce? Well, it gives me cash flow, liquidity, and protection, and I can access it today and I can do so tax free.
That's it. I mean, it's that simple. We really believe that this is because no one showed us anything different. Someone told us something that was better, Jeremy. We would go out and learn about that too. And we're learning a lot of things because we understand that this is only one tool in a system, but it's the foundational tool. Because again, it's giving your dollar three jobs. Like who doesn't want their $1 doing three things at the same time?
Yeah. Yeah. I gave a webinar earlier today, kind of showing how a mortgage statement and the amortization of it, my dollar went out and it went to the bank's, bottom line. And my 2.25% amortized over 30 years was the effectiveness of me paying 38%, right? It's called the total interest percentage. It's on every amortization. But if there's a way to recapture that interest and I have access and control today and I become my own privatized banking system, again, it takes time
It
to be
takes
able to
time.
do that. To be able to do that, it takes time. And right now we're talking about generation two, we're talking about generation three, or your family just starts it at an early age. Typically, what we got to do is we got to start small, somewhere at the end of the day, right? The first best time to do this was yesterday, the second best time is today.
Oh, I
Okay.
thought it was 20 years ago, and then now it's today. So, but
Well,
yeah, I
unless,
mean, when's a better
yeah,
time than now? Maybe we'll put that on our T-shirt. When's a better time than now? Put a bank underneath it, right? So,
yeah. Yeah.
privatized
So
bank.
if you already have good patterns, right? If you're already saving, if you already are putting money away, you're disciplined, My question to you is, what is your access? What's your liquidity? What jobs do you have? Are you actually asset rich and cash poor? Do you have a way to get your dollar to have multiple jobs? Again, it's not a one all be all. I'll be the first to tell you, it's not an investment, right? But it's a hell of a damn good tool as an opportunity fund to help exponentiate. When we're looking at our retirements, I'm going to tell you, it's not about building a larger number at all. This is all about building a financial system, one that can actually support your lifestyle. Again, your life, not mine, not Jason's. So are you building towards a larger number, or are you actually building a financial system?
That's it. And again, like we started, you may make great money. You're a builder. You have a growing business. You have valuable real estate, large retirement account. You're a millionaire, 401k, right? Seven-figure net worth. But again, answer these three questions. What do I keep? What can I access? What cash flow does my system create? Most people, again, they've never evaluated their financial life that way. And that's why we're bringing this to you. They know what they make. They know their net worth. They know how they measure up against the person next to them playing the same game. You might even know your exact 401k balance because you're looking to be that 401k millionaire. But they don't know their real savings rate. They don't know how much of their wealth they could actually access without disrupting the plan. And they don't know what monthly cash flow their current assets are designed to produce. And so that's what we will examine during your personalized review. Like Jeremy said, this is about you. It's not about our plan. It's about what can you do with what you have now, your discipline, your habits. If you think that that's something you need in your life and this moves you, then just go to WealthWise Banking and schedule your conversation because we're going to look at all of these things, what your family earns, what percentage you're actually keeping, where your retained capital is positioned, what could you access if that urgency, emergency, or opportunity, arises. You want to know how can you move and how quickly can you move, and then we can show you where you're exposed. If you're the engine, we'll have this conversation. We'll be real with you. I always ask permission, Jeremy, on my calls. Can I be direct with you now on every call in the future? That's just us asking permission to show you that, hey, you have a pattern and it's moving you away from your goal.
Mm-hmm. Yeah, so that interests you. You can find us wealthwisebanking.com. You can book your personalized review there. I love doing this, right? Because I didn't grow up with wealth. Jason didn't grow up with wealth. When we're creating strong, stable foundations, though, there creates a lot of certainty in an uncertain world. And that's what I want to give you guys is the same peace of mind that I have, the same peace of mind that Jason has. So if that interests you, wealthwisebanking.com, you can book your personalized review there. Until next week, we just want to remind you, you're already in banking.
You're just not the banker yet.
We'll see you guys next week. Take care.
Be blessed. Bye.
Thanks for joining us on WealthWise Banking. If today's episode inspired you, please subscribe, leave a review, and give us a like. It's a simple way to help others discover these empowering strategies and join our community. Together, we're building a network of people who believe financial freedom is within everyone's reach. Remember, financial independence is about making every dollar work for you, one step at a time. Until next time, stay inspired, stay in control, and keep building your legacy the wise way.